Household easy, we close fast and anytime that works for you. Your house don't need it, we'll throw cash, it hits so fast, don't know what to do. Wanted to care to keep it.
So let's recap. Buy, rehab, rent it out, refinance, repeat. This is simple, guys. It's not that hard. But don't forget, really what you want to do is you want to get pre-approved for that long-term financing. That's the first step. Then go find discounted properties and send offers. If you're not sending offers, the answer is no. If somebody's asking $100,000 and I come in and offer 55 and they tell me no, I'm no better off than not making the offer at all. But guess what? Sometimes I offer 55 and they say, well, can you do 60? And I'm like, yeah, let's go. This is a deal. Make offers. Very, very important. So buy properties with hard or private money and buy them at a discount. Rehab and update those properties. You're buying at a discount, building in equity. You're rehabbing, increasing value, building in equity. Those are the two simple things that we are doing to get to the goal of being all in at 75 to 80% or less of what it appraises for. After you rehab it, you're going to rent it out. You're going to rent it out to at the top of the market. Who doesn't want to rent it out at the top of the market? Don't leave money on the table. Sometimes we will beat the highest one on the market and set a new precedent for rent in the area. Refinance it with a long-term lender, guys. Long-term lenders, stay away from the big banks. Go to your small banks, your credit unions, the ones that are local to you and your little county or market or city. Or maybe it's a big city, but you can still find small banks that have 5, 10, 15 branches. The best place to start is credit unions because they're typically not massive and they really, really do appreciate their customer, whereas most banks don't really care. And then you're going to repeat until you can quit your job, guys. That's really all there is to it. So why rental property and why the BRRRR method? We talked about this in the beginning. Passive income. You can quit your job if you do it right. You get freedom, time and financial freedom, tax advantages, wealth creation. Banks love to lend on real estate. And you can use leverage to buy. I leverage other people to rehab. I leverage other people to rent and manage and collect the rent. And manage that process. And then I leverage the bank's money to get all of that done without any of my money and pay back that private or hard money lender. And it's really, really super easy and simple, guys. It's really not that hard. You just got to be consistent. So why rentals? This is the last part. We're going to recap. Cash flow, guys. Passive income is taxed very low. And we'll skip down to the bottom. We're going to create wealth creation. We aren't even taxed on wealth being created. We're only taxed on income. So if you're waking up every day saying, how do I make more money? You got the wrong idea. All you're doing is you're trying to pay your Uncle Sam more of your money. Your goal every day should be, how do I create wealth that's not taxed, that will snowball, that I can borrow against to create more wealth? It's funny how that works, isn't it? Good debt. You guys know my goal. Said it twice already. I want $100 million in debt. I want it to be good debt that somebody else pays off. I want to use leverage. We just talked about that. Last but not least, you have appreciation. It's icing on the cake. Don't expect your property to appreciate 5 or 6% year one or year two, but over a 10 or 15 or 20 year period, it's almost inevitable that that property is going to go up in value. And in fact, over the last 2 years, we've seen some of the most crazy, you guys would agree with this. In the last 2 years, we've seen some of the most crazy appreciation on real estate that I've ever seen in my entire life. Even back in 2006, 7, 5, 6, and 7, it was going gangbusters, but it was a whole different thing. Now it's an increase of appreciation because there's a limited supply. The inventory is low. It's a whole different thing. All right, last slide, guys. I think this is the last slide. That's it. That's the last slide. Amortization. Let's talk about this just for a minute, and we'll be right at 1 o'clock. That'll be 3 hours on the dot. I did good, guys. I did good. 3 hours on the dot. All right, loan amortization. This is something that you need to know if you want to be a BRRRR guy or a landlord, or you want to create wealth using leverage, other people's money, and rental property. So what we have here is a chart. This is an amortization graph. What we've done here is we've used a 30-year loan. The loan amount is $250,000, and our interest rate is 6%. And I just use simple round numbers. 6% is probably a little high, but it's not a bad rate. A term of 30 years is a great term. That would be a traditional loan, or that'd be a conventional, a commercial loan as well. Could also be a 30-year commercial loan. The loan amount, I just did $250 because it was a nice, easy round number. Now you're going to notice that blue line right there is going to be your payment. That blue line is your balance. So it's going to start at, you're going to owe $250,000, but as you get to year 5 and year 10 and year 15, that line's going to drop. You're going to owe less and less on that loan because somebody else is paying you rent and you're taking that rent and you're paying it. Someone else is paying that loan off for you. How awesome is that? And every day, every week, every month, every year, you're going to owe less and less and less on that loan. The green line is our payment. That is payment. I'm having trouble seeing this. And then is that a black line? There you go. That looks a little bit better. Yeah, and then the black line. Let's see here. The blue line is our payment. Yeah, let's look at the laptop. Oh, it's better there. Okay, the black line is the interest. Thank you. So the balance and the interest are inverse. All right? So in the beginning, we're going to be paying a lot of interest. Actually, I think my things are screwed up on here, guys. I apologize. My interest should be the blue line. My balance, I think I might have screwed this up. Either way, though, this is the point you want to make. It doesn't matter that I screwed this up. It's actually kind of funny to me because I do this every day, all day, right? What matters is this. There's 3 things that matter. Over time, somebody else is paying off your loan for you. Number 2, in the beginning, it's interest heavy. So the longer you can stay in an amortization table, the more of that monthly payment is going to go towards paying the loan down. And then last but not least, somebody else is paying the loan off for you. So just go take some time and learn amortization. There's free amortization calculators online that will help you. But basically, why does amortization matter? It matters because if you're going to these big banks, like I mentioned earlier, Wells Fargo, Chase, Bank of America, PNC, there's a whole bunch of them. They're going to give you a loan that's going to balloon after 3 or 5 or 7 years. And then you're going to start all over on your amortization table. And if you are starting all over every time, that means that you're paying a big chunk of interest on that payment every time you start over. Every time I make a payment, more and more of that payment is going into principal, meaning it's reducing the amount that I actually owe in the end. So the amortization is very, very important, and that's why I like all of my loans to renew, not to balloon. And that's a big difference. So how do you get a loan to renew? Well, you go into a bank and you say, I'm looking for portfolio loans, which means I'm looking for you to give me a loan that you keep here in-house. You're essentially giving me the deposits of all those other people that came in with $1,000 to deposit their money. You're giving me that money and all that's staying right in-house on your books. You're not taking that and selling it off to a third party. So guys, that is a recap. That is a wrap. Thank you so much for listening, watching. We can open it up for questions. I am incredibly grateful for this opportunity to share some knowledge and value with you guys and girls. Hopefully you learned more than just a little bit. Hopefully you learned a lot. This strategy has helped me become a millionaire. It has helped me achieve financial freedom. It has helped me achieve time freedom. And it is literally my favorite thing to do every day. I wake up and I say, hey, how can my team and I create more wealth, not more income, because we don't want to pay taxes and we want it to snowball. And we're going to use leverage. We're going to use appreciation. We're going to use depreciation. We're going to use all these different things to just snowball this approach. and make it better, bigger, easier. It's awesome. I love it. All right. Enough of me talking 3 hours. Wow, that was a lot. I've had a great time, though. Let's open up for some questions here.
That was great. So couple clarifiers real quick. Back to your e-pay. Would you have them e-pay their first month and deposit to get them in the monthly e-pay system? I know you'd said cashier check or money order.
Yeah, they can pay online. They can deliver that cashier's check or money order. Typically, people like to deliver it and exchange it for the keys. You know, so a lot of times people want something in exchange. If I hand somebody a check for $2,500, I want something in exchange. I want keys. So most of the time they typically bring it, but sometimes people will prepay online, and then we'll meet them at the property to sign the lease and give them the keys. Or they can come to our office and sign the lease and get the keys. Or they can sign the lease online, pay online, and then we will meet them at the property and give them the keys. All of these scenarios are good scenarios. There's no right or wrong answer. That's a great question. I just think my advice to that person asking is just don't overthink it. All of them work. All of them are good. You're going to figure out what works best for you. And sometimes a tenant may have, they may want to do it a little differently. That's okay. Just make sure that you're not taking cash. That's the main thing.
And so the occupancy inspection, do you need to do that between every tenant?
It depends on the municipality. That's a great question. Some municipalities, if the electric bill or the water bill changes hands, it's a red flag for them that it's a new tenant and they're going to require an occupancy inspection. If you're out in the country in a really rural area, they don't give they don't care at all. So just know your market. That's market research right there. And that could be, guys, this could be so simple as calling somebody on Craigslist or Zillow that has a house for rent. They're obviously in the business already. And just saying, hey, I'm looking to rent this, have you already passed an occupancy inspection? And if they say, what's an occupancy inspection? Then they either aren't doing the business right and they're acting illegally, or they don't have to do that. Or another way, Google City Hall, insert city, call them up and say, hey, I'm a landlord or a potential landlord. I want to be a landlord. When a tenant moves out, do I need to get an occupancy inspection? Occupancy inspections are $40, $50, $60. It's not necessarily a cost. It's more of a safety thing. They want to make sure there's fire detectors and carbon monoxide detectors and railings going downstairs and that the doors lock and the windows secure. The government doesn't want me leasing properties to people that are unsafe and unfit for humans to live there. So the occupancy is really a good thing. Now, it can be a pain in the butt if the occupancy inspector comes in and he's making all these random requests that are unnecessary. That happens from time to time. But typically, it's them just saying, hey, we just want to make sure that, you're not leasing this property to somebody and that there's no plumbing. I mean, come on, that's just common sense. But that's a great question, by all means.
So is it different with commercial lending versus traditional as far as only being able to have 4 loans at a time?
So with traditional lending, you can have either 9, 10, or 11. I get this question all the time. It's irrelevant to me. I only have 2 traditional loans. I always go commercial because I want them in my LLC. And if you get a loan in your name and then you quit claim that property out of your name into an LLC, yeah, you've kind of created some sort of asset protection, but what you've also done is you've voided your title insurance policy. So I'm kind of partial on this question. I'm not a big fan of traditional loans, although I think you can get 9 or 10 or maybe 11 of them. You're going to get a longer term typically and a lower rate. But at the end of the day, you're liable. It's in your name. And yes, you can quit claim it into an LLC, but then you lose your title insurance policy that you probably paid $800 for. And if you want to go sell that property down the road, yeah, you're going to be able to sell it, but it's going to be a little bit more difficult because you don't have a title insurance policy. So that's a great question. Again, I think people overthink a lot of this stuff. Don't worry about the kind of loan you get. Just go into the bank and say you want a loan. And if they say, hey, we got this really great offer on this really low rate, take that. Who cares what kind it is? Just go into the bank, create the relationship, ask for their business. They don't make money unless they lend you money, period. So go in and ask for it. It's a great question. Just don't overthink it, guys. A lot of this stuff is very, very, very minimal at the end of the day in terms of, well, which one should I go with? Just get a loan. That's it.
So let's see about this one. I'm looking for more capital growth than cash flow. I'm looking for cash flow of around 100 to 150. How high can I go with the ARV?
Cash flow of 100 and 150 a month, 150,000 a year. What do you think he's asking? Read it again. I'll do my best.
I'm looking for more capital growth than cash flow.
Okay.
If I'm looking for cash flow of around $100 to $150,
Okay.
how high can I go with the ARV?
You can go as high as you want with the ARV. Just keep in mind that we use a simple formula. It's called the 1% rule. So if I buy a house, I fix it up, and I'm all into it for $100,000, I want that property to rent for $1,000. So I want to see 1% of my all in. Now, here's the thing. It's not 1% of what I bought it for. It's 1% of all of the money that I'm into it for. So the purchase, the rehab, the holding costs, the closing costs, agent commissions if it's listed, whatever. The full amount that I'm into it for. Let's say it's $120,000. As long as that property rents for 1% a month, which would be $1,200 a month, you're almost going to insure $150 to $200 a month in cash flow. So if you want to go up to the $600,000 price point, as long as it rents for $6,000 a month, you should be okay. It's a great question. The 1% rule, I'm surprised that I didn't say that at least once over the last 3 hours. But that is a really, really good thing to keep in mind. The 1% rule is basically, it doesn't necessarily mean it's going to give you a ton of cash flow, but it's basically going to ensure or guarantee that there are some cash flow. So most of my properties are typically somewhere between 1 and 1.3%, meaning I may have a property that I'm all in for $100,000, all in, and it rents for $1,300 a month. So you want to be at 1% or greater. If you're below 1%, again, doesn't mean it's not a good deal. Doesn't mean that it's not going to not cash flow. It still might. It just may not cash flow a substantial amount. I shoot for $300 a month cash flow and $20,000 equity capture. And obviously, if I can get more of either of those, I'm going to. But if I'm only going to get $12,000 equity in a deal and $80 a month in cash flow, maybe not buy that one. Great question. I just want to end with this, guys. This method and this strategy is not a complicated one. Everyone wants to overcomplicate it. Just buy properties at a discount. Market direct to sellers or network with wholesalers. It's okay to pay a wholesaler an assignment fee if you're still getting a deal. So buy at a discount. That's so important. And then rehab the property. Don't just go rehab a property because you think it needs rehab. Go talk to your lender and say, hey, what do you need to see in terms of my rehab so you're going to give me a loan on my appraisal? And don't be rude, but really though, I mean, the goal is what you buy the property for is your business, not the bank's business. So you want to make sure that whenever they come to do the refi, that they're not asking you, so make sure you do this in advance, that they're not asking you for what you paid for. No. You told me you were going to give me a loan on what it appraises for. So send your appraiser out there, and then we'll talk numbers once that appraisal comes back. But when a bank asks me what I paid for it, I'm sorry, I don't need to work with this bank because that's not the game. The game is little to none of your own money. And if you're having to put a percentage in, then that means you're going to have to put money in. I want to build in my equity by buying at a discount and rehabbing, then having the bank get it appraised. I'm going to rent it first, of course, but then having the bank get it appraised, and then me being below what they're willing to lend. And then you don't have to use any of your own money. Other than that, guys, you are capable of doing this, and you are worthy of doing this. And I believe in you. Thanks for watching today, guys. Signing off.
Household easy, we close fast and anytime that works for you. Your house don't need it, we'll throw cash, it hits so fast, don't know what to do. Wanted her care to keep